Hello and welcome to Market Watch for another week. I'm actually going to go back to last week because it's more important at the moment with regards to where we sit. We are 6 and a bit weeks away from the end of the year. 2019 from a market's perspective is going to be astounding. There's no doubt about that. Unless something really, really untoward happens, US-China trade issue completely collapses, or that the Chinese do something really, really weird, we are going to have a good year across the board. We are likely to see probably a doubling of what we normally see on a capital basis and also on a total return. So what I want to concentrate on is what leads into 2020. And realistically, from our perspective, you can't go past at the moment monetary policy and macroeconomics because they are really going to be big drivers in 2020. Charts are back, and let's start with this because this is an absolute snorter with regards to what is currently being said by the RBA and what's actually happening. First and foremost, have a look at these three lines. You've got the green line, a blue line, and also the yellow line. And having a look at them, you've got unemployment, underemployment, and underutilization. And this is from when the RBA started cutting rates in 2011 to where we are today. The whole mandate of what it's been trying to do is to bring the slack in the economy in this chart down. And as you can see, since they've been cutting rates, it's been going the other direction. Underemployment is the key standout here. So let's have a look at this chart. This is underemployment, unemployment, and underutilization since we actually had numbers beginning. It goes back to basically 1979. And have a look at that dark blue line of underemployment. It's at a record all-time high. And that, again, shows you very clearly not just that the economy is sluggish, but it shows you very clearly that people's employment is becoming harder and harder. And those that want to work more is getting more and more. Those take-home pay issues that we currently have are only getting stronger. That's what those charts tell you. It's very clearly what comes out with regards to where we currently sit and what it actually means. So why I highlight this to you is that the RBA is now in another level of pain. It is going to have to cut rates in 2020 at least once more. And off the back of what we saw last week with that employment data I just showed you, expectations for April and February now jump through the roof. February, 62% chance of a rate cut. April is close enough to a certainty in terms of what happened. So that 0.5 of 1%, new record all-time low in the RBA cash rate is there. But what also happened last week is what was announced with regards to an upcoming speech by Philip Lowe. And I think this is more of a really big point going forward, is that the speech title is looking at other countries' use of unconventional monetary policy. If that's not groundwork, I don't know what is. It is clear that the RBA has been wargaming this. It is now also clear they're going to put it in the public, tell you that it's coming, and probably do it this time next year. Now, why I highlighted all this, and coming from the fact that this is obviously markets and what has markets been, let's have a look again at the RBA cash rate since 2011 to now inverted to this. I've shown you this chart many times. And you can see very clearly that asset appreciation is what monetary policy is designed to do. It's not just a housing and property market mover. It is an everything asset mover, and I've shown you that before. Total returns, capital returns are in this chart. You can see that since 2011, it has been powering on. It suggests, and very much the trend is there, that 2020, even if we get all that slowness I just alluded to, will be moving through asset prices again. Expectations have been well and truly in the media around property, possibly moving 15%, for instance, in Melbourne. But I think you also need to look at it from this perspective, is that equities are probably also going to pick it up. Whether that's good or bad is a debate we can have all the way through next year. But what is very clear from the end of 2019 is that once again, that softness in the middle of the year is going to really ramp up and filter through into early 2020, which means it's going to really put pressure on monetary policy, which means it's going to put upward pressure on assets.